Now, the world's unluckiest investor managed to invest at all the worst possible moments in recent financial history, right before the stock market crashes, the global recessions, and the market meltdowns. And yet they still ended up making over 300% gain in 27 years. And that sounds impossible, right? But here's the twist. Despite their terrible timing, they stumbled across something which most investors will never grasp. It's not about picking the right stocks or even predicting what the market's going to do. It's something more simpler and way more powerful. Now, in this week's video, I'm going to tell you a story about catastrophic failure and terrible bad luck, but how it turned into a fortune despite all the odds. So welcome back to the Personal Finance Crew, and if this is your first time, a very warm welcome. Hi, my name is Simon, and I'm a chartered financial planner with decades of experience helping literally hundreds of clients, as well as their families, prepare well ahead of time for their retirement with confidence. Now, we all know that money matters, so let's try and make money make sense. So successful investing is often perceived as a game of excellent timing where you buy low and you sell high. But what if you had the worst possible timing imaginable? What if you just stuck a pin in the chart and invested at all the wrong times? If you'd invested at the worst times in living memory, how would you have performed? And would it have been a complete and utter financial disaster? Well, I'd like to introduce you to Billy, who I've dubbed the world's unluckiest investor. Now, despite having absolutely no idea when to invest or even how to invest, he went ahead anyway and consistently managed to invest at the stock market highs before economic recessions or market meltdowns. Now, his story highlights a simple but powerful insight into the emotional resilience that we all need, and that's a requirement for investment success. But Billy's goal was very straightforward. He wanted to grow his wealth over the long term. He knew that markets had their ups as well as their downs, but he vowed to himself that he was going to ride out the storms no matter what. But here's the catch. Billy had a talent for investing his money in the market at the worst possible moments in living memory. But what he did do was he held on to his investments through thick and thin. He didn't panic, no knee-jerk reactions. He managed to control his emotions, following the basic principle of it's time in the market that matters, not timing the market. So before we get into the rest of this video, I just want to say a big thank you to our friends at TrustNet and also at Vanguard, as we've used some of their analysis to help me put together this story and this video. So before he started his investing journey, what Billy did know is that he wanted to have a globally diversified fund as well as a low-cost fund, so he managed to pick the FTSE All World Index to follow. Now he knew where to invest. He decided to make his first investment of £2,500 in September 1997. Now, for those of a certain age like me, this was a time in the UK which was buzzing with Cool Britannia. The Verve had just released Bittersweet Symphony. The Spice Girls had dominated the charts, and the nation united in grief over the death of Princess Diana, and then Robbie Williams released the absolutely iconic Angels. Now you can see here on the orange line that the market had been rising steadily and strongly for some time, and Billy had invested at the peak of the market. Then what happened? Well, then the Asian financial crisis hit. This started initially in Thailand with the collapse of their currency, and then this crisis then spread rapidly, wreaking havoc throughout Southeast Asia. And unsurprisingly, this led to a stock market fall of about 15%. Despite being annoyed with himself and at his very bad luck, he continued to save and decided to invest for a second time, and invested a further £2,500 in July 1998. Now here you can see the huge drop in the stock market, followed by the very quick recovery as well. Again, Billy had invested after the recovery at market highs. Then what happened? Well, then Russia defaulted on their debt, which at the time was the largest in history, and that contributed to the collapse of Long-Term Capital Management, which was a hedge fund in the US, and they needed a $3.6 billion bailout, but that was back when $3.6 billion was a lot of money. In time, it looked like the market seemed to be recovering, so Billy then continued to save, and he wanted to invest for a third time. So this time he invested £10,000 in mid-2000. Now you can see here where Billy invested just before the dot-com bubble burst, which saw an absolutely devastating stock market fall of up to 78%. Now, this collapse was triggered by a combination of hypervaluation of technology stocks, unsustainable business models, and of course, speculative investing. Now, does any of that sound vaguely familiar to what's going on right now? So if you're finding value and enjoying the story of Billy, the world's luckiest investor, then give the video a like and please subscribe to the channel as we are closing in on a community of 10,000 strong. Don't forget to hit the notification bell as well so you don't miss any of this weekly valuable content. Now, despite having invested £15,000 to this point, but with appalling timing, his fund value stood at this point at a little over £21,000. So he thought to himself, this actually wasn't that bad considering what happened in 1997. So for his fourth investment, he invested another £5,000, and that was in October 2007. Now, there have been literally millions of paragraphs written about the global financial crisis, but here are some statistics about what then became known as the Great Depression. So unemployment had doubled to 10%, 3 million homes were repossessed in America alone, 6 million people lost their jobs, and the Dow Jones fell by 50%, and the S&P 500 fell by 58%. Now, Billy saw significant volatility as he thought that capitalism was literally coming to an end, with Lehman's going bankrupt, financial institutions being forced to merge, and it all ended up with a bank bailout as well as money to support global economies to the tune of $29 trillion. Now, undeterred, Billy wanted to invest for a fifth time, and this time it was £10,000, and that was towards the end of 2019. You can see here where Billy invested after a very strong stock market recovery and rise. But can you remember what happened next? Absolutely. The stock markets were then confronted by a global pandemic where COVID-19 then swept across the world, and the stock market fell by an astonishing 35%. And this is one of the quickest, sharpest and most profound falls in stock markets in living memory. Now, at this point in time, I remember vividly clients were calling me in a panic and no one knew when or how it would all going to end. The recommendation then, however, as it is now, is to focus on the plan, to remain invested, not to panic, no knee-jerk reactions, and above all, to control your emotions. Now, after the vaccines were rolled out, the market started to recover. And as Billy was getting closer to his retirement date, he decided to have a sixth and a final investment into the stock market to boost his retirement income and his retirement options. So he decided to invest a final £5,000 in December 2021. So no sooner had the COVID restrictions been lifted in the UK, within 24 hours, Russia had invaded Ukraine. So let's have a look at Billy's investing history. First investment, £2,500 in September 1997. A second investment of £2,500 in July 1998. A third investment of £10,000 in June 2000, a fourth investment of £5,000 in October 2007, a fifth investment of £10,000 in September 2019, and a sixth and a final investment of £5,000 in December 2021. So that's a grand total of £35,000 invested in 6 of the worst moments in recent stock market history over the last 27 years. So what's the fund value of the world's worst investor who finally retired in September 2024? Well, the final valuation was £146,450, and that's a 318% return on his investment in 27 years. So what lessons can we learn from this? So although he underperformed the FTSE All World Index as you would expect with his bad luck, he still made a far greater return than cash, bonds or inflation. So here's the rules. Stay invested, embrace a long-term mindset, avoid market timing, and just start investing when you feel comfortable. Make sure your investments are diversified, stay disciplined, and don't panic. As Billy's now retired, he's going to need to know how to take his tax-free cash and how to calculate his state pension. So I've linked a further 2 videos in this series to help you all do just that. So thank you so much for watching to the very end and for your time and for your patience. As always, I'm going to see you all again next week.